Hello people, Dr. Wang is here recording. Today we are going to cover Chapter 5, Accounting for Merchandising Operations. If this is the first time you hear about this word, merchandising or merchandise, that means your product, and in particular physical products. If you're running a clothing store, then your merchandise would be jeans, trousers, jackets, shirts. If you're running a car dealership, your merchandise would be cars. If you're running a fast food store, your merchandise would be hamburgers, fries, ice cream, and beverage. So merchandise means your products and the physical products. We're going to learn how to identify merchandises and conduct related accounting activities. And also we will do inventory control and also construct cash flows related with inventory assets. And we are also going to calculate these ratios related with profitability and also debt ratios. And we are also going to do a lot of procedurals, but we don't have to worry about all these topics now. We will just go over them one by one in the next section. First, how to describe merchandise activities and identify income components for a merchandising company. So this company is not a merchandise company. This is called a service organization. So basically they sell time to earn revenue. Examples would be accounting firms, law firms, and plumbing services. So they provide services instead of a merchandise. So when they provide services, they will earn revenues based on the time they devoted and the work they put in there. And then minus expenses, they got net income. So that's a regular way to calculate net income, which is revenues minus expenses. For a merchandiser, if you're running a company that is selling products instead of just services, then the merchandise would go from a manufacturer or the factory where it is produced to a wholesaler, to a wholesaler or distributor, and then from a wholesaler it will go to retailers. So that means more sellers and in a much smaller amount and a more specified sorts. And from retailers it will eventually reach customers. And your job as a merchandiser is either a wholesaler or a retailer. If you're a wholesaler, your customers not only include retailers, but also the customers in general. And if you look at the procedural for a merchandiser to generate a profit, for example, they are selling sporting goods like hockey stuff, or clothing, or auto parts. So these are all the products, physical product they sell. So of course they gotta generate net sales from delivering those products to their customers. And also they have to deduct cost of goods sold, because when they sell each of these product, they also need to purchase from a wholesaler or from a factory. After that is deducted, you will get an item called a gross profit. If you look at the income statement right here, when you use the net sales subtracted by cost of goods sold, you should get a gross profit. And then after you get a gross profit, you need to deduct all the expenses like rent, utilities, salaries of your employees. And then what you get is net income. You still use revenues minus expenses. The thing is, for this case, you also need to deduct the cost of goods sold. And the cost of goods sold are the products shipped from the factory to your store. And of course, you gotta build up an inventory to store those products. And what you see here is that this is a bicycle company, and the first step is to purchase this merchandise inventory. You have this cash, you spend the cash to buy these bikes, and then you will sell the bikes to a customer. However, when you sell the bikes, you may not just sell it for cash. They may just pay by credit card. Okay, And credit card payment or credit sales is a very important component of a modern business. Not everything nowadays are paid or received through cash. Instead, many of the business transactions are done with credit. Just like in old days, people use gold to do the trading, and gradually cash or paper money replaced the gold. So nowadays, likewise, cash is becoming more scarce resource and credit is becoming more abundant. So people tend to use a credit to conduct business instead of cash. So back to our cycle, you will see after the sales is made or the sales is recognized, then that will be billed as accounts receivable. So you have some money to collect from the credit card company or from the customer who swept the credit card. And after a certain time period, you will collect the account receivable to cash. All right, so that is normally after 1 month to 3 month period. So if you look at your inventory system, so it comes with the beginning inventory, and then you purchase some stuff from a factory or wholesaler. That's called net purchases. So this would be the merchandise available for sale. And then you will sell some of the products that will be recorded as a cost of goods sold. And then the rest of the item would be put in ending inventory. So that's two sides of the equation. And you have two inventory systems. One is called a paper chew systems, which is updated for each purchase and sales of a merchandising. So that means whenever you make a merchandise, whenever you make a transaction or a sale, no matter how small that amount is, you update your inventory system. You also have a periodic systems. So that is updated only on a periodical basis, normally at the end of the accounting period. So here we have an example. So use the following information from a merchandising company and from a service company. All right. And for the merchandise only, calculate the goods available for sale, cost of goods sold, and gross profit. And also calculate net income for each company. So this is a merchandiser and this is a service company. As you can see from its name, it's called High-Tech Services. So they provide software which does not quite count as merchandise. So right here, if you look at the merchandiser's inventory, you have the beginning inventory, ending inventory, net purchases, and also you have net sales. All right. And for the high-tech services, you have expenses, revenues, cash, prepaid rent, accounts payable, and supplies. So first of all, if you want to compute the goods available for sale, you need to have this beginning inventory added by net purchases. So that's 180 for the merchandising company. And then we measure cost of goods sold. So now you have goods available for sale, and you want to know how many you have sell. And you need to first get a count of how much left. So the beginning inventory plus the net purchases is the goods available in total. So that's your total merchandise. And then minus the leftover is how much you actually sold. So here's the trick. After you get this goods available for sale, you will less ending inventory that's left over. Then in total, you have sold $130 worth of merchandise. How do you compute a gross profit? Well, you need to use a net sales minus cost of goods sold. All right, that basically is your gross profit. And for the net income for this company, once you have a gross profit, you will need to deduct the expenses, and then that's your net income. And for the high-tech company, you just get the revenue and deduct the expenses, and then get net income. That's it. So for the high-tech company, You see you have accounts payable, supplies, cash. So these are irrelevant. So you only need to look for revenues and expenses.